Becoming a real estate investor is a core part of the dream of wealth for millions, but the reality is often a gauntlet of tenants, toilets, and taxes. With the median U.S. home price over $400,000, the down payment alone is more than most people's annual salary. But what if you could own a fractional piece of $1 billion portfolio of premier properties, from apartment buildings and shopping malls to data centers and cell towers, with a single click for less than the price of a nice dinner? This isn't a fantasy. It is one of the most powerful and accessible investment vehicles in modern finance. In the next 10 minutes, you'll learn exactly what a real estate investment trust, or REIT, is. You'll understand the unique legal structure that transforms these companies into powerful, passive income machines. And you'll learn a framework for analyzing them to add the benefits of real estate to your investment portfolio, without the headaches of being a landlord. A ARREIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate. They were created by an act of the U.S. Congress in 1960 with a specific mission: to give everyday investors access to the profits of large-scale commercial real estate, in the same way that a mutual fund gives investors access to a basket of stocks. But what makes a REIT truly unique is a special legally mandated rule. To qualify for its special tax status, that is, to avoid paying corporate income tax, a company must adhere to several conditions, the most important of which is this: it must pay out at least 90% of its taxable income to its shareholders in the form of dividends. This rule is the engine of the entire REIT structure. It legally forces these companies to be shareholder-friendly, high dividend-paying machines. The trade-off is that with such a high payout, they retain very little internal cash for growth. To acquire new properties, they must regularly go back to the capital markets to either issue new shares or take on debt. This 90% mandate is the magic behind the REIT structure. But REITs are not a monolith. They come in dozens of specialized sectors, each with its own unique economic drivers. So, what are these different types? And how do you choose the right one for your portfolio? The vast majority of publicly traded REITs are what we call equity REITs, meaning they directly own and manage physical properties. They are the landlords. These are typically categorized by the type of property they own. Theory: the sectors of the REIT universe. Residential REITs own and operate multi-family apartment buildings and single-family rental homes. Their performance is tied to population growth, job creation, and housing affordability. Retail REITs own shopping malls, strip centers, and outlet malls. Their success is tied to consumer spending and the health of their brick-and-mortar tenants. Industrial REITs own warehouses, logistics facilities, and distribution centers. They are a primary beneficiary of the growth of e-commerce. Office REITs own and manage large office towers in central business districts. They are sensitive to employment trends and, more recently, the shift to remote work. And specialty REITs, which own unique assets like data centers, cell towers, self-storage facilities, casinos, and even timberland. Analogy: the franchise investor. Choosing to invest in REITs is like deciding to buy shares in a massive restaurant franchise company, instead of trying to open your own restaurant from scratch. Opening your own restaurant, direct real estate ownership, requires a huge upfront investment. You have to manage the staff, tenants. You have to fix the broken freezer, repairs. And your entire fortune is tied to the success of that single location. Buying shares in the franchise company, a REIT, allows you to own a tiny piece of thousands of locations around the world. You have a professional management team handling all the day-to-day operations. You simply collect your share of the total profits in the form of a dividend, without ever having to step foot in a kitchen. Example: the key REIT metric. To analyze these companies, you must learn their language. For a normal company, we look at earnings per share, EPS. For REITs, this metric is deeply flawed because accounting rules require them to deduct a large, non-cash expense called depreciation, even if their properties are actually increasing in value. A far better measure of a REIT's true profitability is a metric called Funds from Operations, or FFO. FFO takes a REIT's net income and adds back the depreciation charge to give a more accurate picture of its actual cash flow. When you analyze a REIT, you should use the price to FFO, PFFO ratio as your primary valuation tool, not the PE ratio. The goal of any sound REIT wealth management plan is to find companies with a long track record of growing their FFO per share, as this is the fuel for a growing dividend. Understanding FFO is crucial for avoiding the two most common pitfalls that trap REIT investors. Pitfall number 1. Ignoring interest rate sensitivity. Because REITs are legally required to pay out most of their income, they are often viewed by the market as bond proxies. This means they can be highly sensitive to changes in interest rates. When interest rates on safe government bonds rise, the high dividend yield of a REIT becomes relatively less attractive, which can put downward pressure on its stock price. Their ability to get favorable mortgage rates for expansion is also impacted. Pitfall. Number 2. Confusing equity, REITs with mortgage REITs. The vast majority of REITs we've discussed are equity REITs that own physical buildings. There's a smaller, much riskier, and more complex category called mortgage REITs, MAREITs. These companies do not own property. They own mortgage debt and other mortgage-backed securities. They are essentially highly leveraged bets on the spread between interest rates. They are not for beginner investors. Avoiding these traps is crucial. But for investors who want to go a level deeper, there's a specific metric that can signal the true, underlying value of a REIT's property portfolio. The advanced strategy: analyze the net asset value, NAV. The ultimate pro-level tool for analyzing a REIT is to value it based on its net asset value, or NAV. NAV is an estimate of a REIT's true, underlying worth. It's calculated by taking the current market value of all the REIT's properties, subtracting all of its liabilities, and dividing that by the number of shares outstanding. It is the private market, real-world liquidation value of its real estate portfolio on a per-share basis. Professional analysts and dedicated REIT investors constantly compare a REIT's current stock price to its estimated NAV per share. If a REIT stock is trading at a significant discount to its NAV, it can be a sign that it is undervalued. You are effectively buying its portfolio of high-quality real estate for 80 or 90 cents on the dollar. If a REIT stock is trading at a significant premium to its NAV, it may be overvalued by the public market. This method anchors your analysis not just in the company's cash flow, but in the hard asset value of the real estate itself. It is the most powerful tool for finding a margin of safety in the REIT market. Let's distill this into the 3 essential principles of REIT investing. REITs are your gateway to commercial real estate. They are companies legally mandated to pay out at least 90% of their taxable income as dividends, making them one of the most powerful and accessible passive income vehicles. Think in FFO, not EPS. To properly analyze a REIT's profitability and valuation, you must use the industry-specific metric of Funds from Operations, FFO, which gives a truer picture of its cash flow. Anchor your analysis in NAV. The advanced strategy is to value a REIT based on its net asset value. Comparing the stock price to the underlying private market value of its properties is the ultimate tool for identifying undervalued opportunities. REITs allow you to be a landlord to the world's greatest companies without ever having to take a call about a leaky faucet. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.